Hi everyone, welcome to another update on the stock screener. Today we're going to talk about Hemisphere Energy. I told myself not to buy oil stocks when the oil season is over, but I couldn't help it. I couldn't help it. It could come down a bit into Q1 with recession and oil season ending, but I couldn't help it because Hemisphere Energy is really cheap. So this company has not participated in the oil rally. As you can see here, it has done nothing, which means I scoop up the shares. So oil went up 25% and this here has done nothing. So I was looking at the valuations and I think it looks very cheap. So 99% heavy oil. So WCS price is typically $20 lower than crude oil, and I think it's currently around 90 then, right? If crude oil is at 90, then we do 20 less and then convert it back to Canadian dollars, so that's about $90, right? So that's what I used. We know the capex, it's around 18 million per year. Doesn't change a lot. Production is around 3,000 and they are going to drill some more wells. So 2 wells still coming online, could rise to 3,100. So I took 3,100 around that level. I don't think there is much growth in this company, but it gives nice dividends at 3,000 barrels heavy oil. SG&A 3 million. Revenue is 72 CAD for the last quarter. Since then, we have gone up to 90 probably. I know the differentials are increasing on heavy oil, but yeah, that's due to the Trans Mountain Pipeline delay. But eventually, yeah, it could stay around 80 to $90. 70 to $90 should be doable. All-in cost 14. So one of the low-cost producers. 14 is very cheap in all-in costs. When you have a revenue of 70 to $80, this is a very good company. No debt, interest is very low. So all good things. Royalty 23%, 25% tax. So tax, they are already getting taxed. The others have tax pools, so when those tax pools are gone, then those taxes will come back. This one has already been taxed, so the valuations are already very good. So it's not like they will get another tax on top of that. We already get taxed, and the valuation is already 5. Enterprise value to free cash flow is 5, so you get a 20% yield every year, right in the pocket, because they don't have debt to repay. So you get 20%. Leverage is not that great, 1.6 leverage to oil. But anyway, it's a cheap company to buy. And you can see that here we are currently at 5 times free cash flow based on $90 oil. And I already deducted 25% tax on that. So it's a good buy to diversify into oil. Balance sheet looks very clean. So current assets 10, not a lot of debt, and good equity value. Revenues 19 for the last quarter. and income at 5 million. Okay, for the last quarter, because oil has gone up since then, so we should have more income now, around 6 million, 6, 7, 8 million, based on these numbers here. So 6, 7 million per quarter. So that gives us 25 to 30 million per year. So that's a PE of 5. That's a good number. Yeah, that's a good number. And it will look like this on the NPV flowchart. You get your money back in about 10 years, but in the meantime, you get a nice dividend. Dividend of, they can give it here even, it's a dividend of 8%. Not bad, it's higher than bonds. Bonds get you 4.5%. This will give you 8%. And this dividend is sustainable because the PE is 5. So they can grow and pay dividends at the same time. So it's not a double or triple, it's just a way to diversify and get an 8% dividend on that. Of course, there is upside if oil goes up. We don't know yet if oil is going in a massive bull market or not. But let's say oil is going to 100, then 110, 120. Let's say 120. Okay, 120, all-in cost of 14.5. This is the production. And this is in CID, so that's heavy oil. Heavy oil could maybe go up a bit with Trans Mountain coming online, etc. Let's say the capex stays the same, interest being paid off, same tax rates. Then we get net income maybe to 40 million to 45 million if oil goes up from 90 to 100 to 110. So let's see what the price to free cash flow is going to be. This divided by net income. So currently 4.7 PE, and this could go to 3 PE. So a very cheap company if oil can go higher. Probably upside of 50%, 70%. Not bad, and you get paid a dividend. Let's put it back to 100. We should be able to stay at 100, I think, in the coming years. The great thing about this is that even if oil goes down, as you can see here, this company is not going bankrupt at all. It has a break even of around $50 heavy oil in Canadian dollars. So this company cannot go bankrupt as long as it produces oil. I can show that here as well. Let's say 60. Let's start with 60. Doesn't look that great at 60, so I wouldn't hold this when oil goes to $60, but they still have cash flow. So this company will survive. 5 million net income at 60 oil. Um, that's a bit overvalued. Yeah, that's very overvalued. But I don't think oil can go to 60. Let's say 70. 70, then we have 12 million net income, PE of above 10, 12. That's a normal PE. I wouldn't hold it either at 70, but I don't think oil will stay at 70. I think 80 is more likely and higher. And you can see that we are fair value actually at $80. 20 million net income, PE of 7. PE of 7 is acceptable. Okay, so not a lot of downside risk. This is a low cost producer without debt, so very cheap. A good hold for people that don't want to worry about anything. Also, mine life is pretty high, 2P reserves of 16 years. So this company can just keep on drilling and stay alive for at least 16 years. So yeah, cash flowing machine. I bought some. Now let's hope that oil keeps rising. And yeah, oil is rising. I have to admit, I don't know where oil is going to go to. We had a capex cycle going up here, then capex went down. Maybe we are now entering another capex cycle up. So up, down, up. We could even go to $120 if we believe that the capex cycle for oil is now going into the positive. So let's see if we go to 120, then we have this data point. And that means that there is an upside of 150 to 250 based on 5 times free cash flow. That's an upside of 60-70%. So there's not a lot of leverage, but there's also not a lot of downside risk. So safe play. Upside is indeed at 120 oil. If we are in a capex growth period, then you can see here that the upside is indeed almost a double based on the NPV. Okay. And at current prices, we are slightly undervalued. At a price to free cash flow of 5 with high mine life. EV to free cash flow of 5. So I think this is a good buy. Okay. Just small update on Hemisphere Energy. This one has not participated in the oil rally. So now it should start to outperform. And I'll see you in the next video. Bye.